You've spent decades saving for retirement, but how much of that money will you actually get to keep?
Taxes don't stop when you retire. In fact, without proper planning, you could end up paying more in taxes than necessary.
I'm April with White Oak Planning.
And I'm Jerry. Today we're talking about tax planning for retirement, so you can keep more of what you've worked so hard to save. Most people think about saving for retirement, but they don't think about taxes in retirement.
Here's the reality. Where your money is saved matters just as much as how much you've saved.
If all your money is in traditional 401ks and IRAs, every dollar you withdraw is taxable income. Depending on your other income sources, that could push you into a higher tax bracket.
If you have tax diversification, money in traditional accounts, Roth accounts, and taxable brokerage accounts, you have flexibility to manage your tax bill in retirement.
Tax planning is about controlling when and how you pay taxes so you can minimize your lifetime tax burden.
Tax diversification means let's get an understanding of tax diversification. Tax diversification means having money in different types of accounts with different tax treatments.
Tax-deferred accounts, traditional 401ks, and IRAs give you a tax break now, but you pay taxes when you withdraw.
Tax-free accounts, Roth IRAs and Roth 401ks, for example, don't give you a tax break now, but withdrawals are tax-free in retirement.
Taxable accounts, like brokerage accounts, don't have contribution limits, and long-term capital gains are taxed at a lower rate than ordinary income.
Having money in all three buckets gives you flexibility, gives you options. In a high-income year, you can withdraw from Roth accounts to avoid additional taxes. In a low-income year, you might convert some traditional IRA money to a Roth.
This flexibility can save you tens of thousands of dollars over your retirement. One of the biggest tax challenges in retirement is required minimum distributions, or RMDs.
Depending on the year that you were born, you're required to withdraw a certain percentage from your traditional IRAs and 401ks every year once you reach a certain age, whether you need the money or not.
Those withdrawals count as taxable income. If your RMDs are large, they can push you into a higher tax bracket, increase your Medicare premiums through IRMA surcharges, and even cause more of your Social Security to be taxed.
This is why Roth conversions before your RMD age can be so valuable. By converting traditional IRA money to Roth earlier, you reduce your future RMDs and create tax-free income later.
You'll pay taxes on the conversion, but if you do it strategically in lower income years, the long-term benefit may be significant.
Many people don't realize that Social Security benefits can be taxable.
That's true. Up to 85% of your Social Security benefits can be subject to income taxes, depending on your other income.
The formula is based on your combined income, which includes your adjusted gross income, tax-exempt interest, and half of your Social Security benefit.
If your combined income exceeds certain thresholds, more of your Social Security becomes taxable. This is another reason why managing your withdrawals from retirement accounts really matters.
Withdrawing from Roth accounts doesn't count as income, so it won't affect how much of your Social Security is taxed. That's a powerful planning tool.
We've mentioned IRMA a few times. Let's talk about what it is and why it matters.
IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge on Medicare Part B and Part D premiums for higher income retirees.
Your IRMA is based on your modified adjusted gross income from 2 years prior. Your 2025 IRMA, for example, is based on your 2023 tax return.
If your income exceeds certain thresholds, your Medicare premiums can increase significantly. For some retirees, IRMA surcharges can add hundreds of dollars per month to their Medicare cost.
This is another reason to be strategic about withdrawals, Roth conversions, and managing taxable income in retirement.
So how do you actually withdraw money in a tax-efficient way?
There's no one-size-fits-all answer. But here are some general principles.
First, consider filling up your current tax bracket with traditional IRA or 401k withdrawals. If you're in the 12 or 22% bracket, withdrawing enough to stay within that bracket can be smart.
Second, if you need additional income beyond that, pull from Roth accounts or taxable brokerage accounts. Roth withdrawals are tax-free, and long-term capital gains from brokerage accounts are taxed at lower rates.
Third, be mindful of IRMA thresholds. If you're close to a threshold, pulling from Roth or taxable accounts instead of traditional accounts can help you avoid surcharges.
And fourth, consider qualified charitable distributions if you're charitably inclined. Once you're 70 and a half, you can donate up to $100,000 per year directly from your IRA to a charity. It counts toward your RMD, but it doesn't count as taxable income.
In a blended family, tax planning becomes even more important.
You might have different account types, different income sources, and different beneficiaries.
Coordinating your withdrawal strategy as a household can help you minimize your combined tax burden. Thinking about how account types pass to beneficiaries is important for estate planning.
This is complex stuff, and it's where working with a financial advisor and a tax professional can really pay off.
Here's your action step. Look at where your retirement savings are currently held. Do you have tax diversification, or is everything in one type of account?
If you're heavily weighted toward traditional accounts, consider whether Roth conversions or Roth contributions may make sense for you going forward.
And if you want help building a tax-efficient retirement strategy, schedule a complimentary Connect call using the link below. I'm April with White Oak Planning. If this opened your eyes to the importance of tax planning in retirement, subscribe and share it with someone who's preparing for their future.
And I'm Jerry. Taxes are one of your largest expenses in retirement. Plan for them strategically. We're White Oak Planning, helping families build financial confidence and grow stronger together.